Welcome to No More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen.
Welcome back, everybody, to the CreditSights No More, Risk Better podcast. My name is Logan Millar. I'm the head of European strategy in London, and today I am pleased to be joined by my colleague in LFI, Luke Millar, who is the global editor-in-chief. Today we're going to talk about all things Euro leveraged finance. Really excited to talk about this topic. It's far more interesting than I think the investment grade market that we're always talking about and focused on with some of our main clients. This is much more, I think, of a interesting dynamic and sort of a credit pickers market. So, Luke, welcome to the podcast. Thanks for coming back on.
Thank you very much indeed, Logan. I'm honored to be invited back and hope that I can be of a modicum of interest as your lead suggested.
No, I think it's going to be great. Every time we do a podcast, it seems to be very engaging and uplifting in terms of how you're kind of seeing the market. Obviously you're kind of in the weeds when it comes to talking to all sorts of constituents in the left fin market, whether it's bankers, analysts, PMs, all that jazz. So definitely excited to hear your perspective. I guess just kind of starting off, I kind of want to set the tone a little bit in terms of kind of what's been driving the Euro 11 market this year, how things have performed, and then we could sort of get into to more of a discussion. But I think all things considered, this year it's definitely, I think, been a decent year for performance across Euro high yield and leveraged loan markets. I think one key takeaway that I have and some sort of the key development is that interest rates, I'd say, have been moving considerably higher in Europe, especially at the long end of sort of the yield curve. I think this is obviously stemmed from expectations for a kind of a renewed fiscal impulse coming from Germany, but nonetheless, credit spreads in high yield and loans, otherwise known as kind of risk premiums versus government bonds, have been narrowing quite significantly. And so you're having this sort of inverse relationship between long and interest rates and yields, and that we've seen pretty considerable spread tightening over the course of this year. I think there's a number of reasons that we would point to in terms of the strong performance that we've been seeing. One, I think we've seen a surprisingly strong and continued reach for yield. This is something that's been, I think, firmly intact for a number of years now, really since kind of, inflation peaked in sort of late 2022. Since that period, we've seen investors continuing to, lock in really, compelling yields by historical standards. And so that's been one key kind of theme, I think, driving spreads tighter. The number two thing I mentioned is just really strong technicals, and that sort of ties in with the kind of reach for yield mantra. But if you look at sort of new issue supply, and we'll get into this on the podcast, but new issue supply across, especially on the high yield bond market, has been fairly digestible, especially on a net basis over the last couple of years. And at the same time, you have that sort of strong bid for yield. So you're seeing continued strong inflows into leveraged finance asset classes, which is keeping risk premiums tight. And then the third one, obviously, is near and dear to the leveraged market, is just resilient fundamentals. I mean, there's obviously some one-offs and certain special situations that you can point to that isn't necessarily telling you the most healthy story around fundamentals, but in general, high yield fundamentals are still holding up quite well. I think that ties into kind of a resilient economic backdrop. And also the fact that, fundamentals are coming from a fairly healthy starting place. So let's kind of dive into it, Luke. I think we, start off by just discussing some of, your biggest takeaways and I guess surprises for 2025. I guess I'll start with mine before we jump into yours. One is, I think, for all the talk around tariffs and trade, the macro environment has been, I think, less punishing to fundamentals than, what the market had feared back in April. The number two big surprise for me is that, economic uncertainty in some ways has actually encouraged companies to re-strengthen balance sheets or at least maintain sort of lean balance sheets. And then number three would just be that high yield investors, appear willing to lend to the right companies at the right levels. And that's, I think, been both supportive for technicals and fundamentals. So Luke, I guess let's dive in. Let's talk about what's going on the high yield and loan primary market.
Yes, thank you, Logan. It's been a busy year for primary on a gross basis. I think our numbers at LFI show it's already the second highest annual volume already been recorded in 2025. And if I look at the loan market, it's the largest volume already post GFC. So easy. But that's gross volumes. It has been opportunistic transactions that have clearly led the way. High yield, about 70% of the volume has been refinancing. That doesn't mean there hasn't been some new money in there. There has. We've seen pockets of loans to bonds transactions. We've seen the reverse Yankee trade. Some companies have issued euros to take out their dollars. We've seen some RCF pay downs. So there is new money opportunity there, but by and large, it's been, especially in the latter part of the year, double B refis. And that double B refi trade really took a bit of time to come to fruition because they all sat on very low coupons before the interest rate rises. Nobody really wants to turn 2-handle, 3-handle coupons into 4, 5-handle coupons, understandably. But as those 26 maturities and early 27s have started to come into view, they've started to address those. On the loan side, it's similar. That record volume is largely driven by repricings, which accounted for about 45% of the volume. You add another 20% for refi, and you can see that that's also been an opportunistically heavy market. But the difference is that there has been a greater LBO volume in loans, as you would expect. It's the sort of asset class of choice for sponsors. And the LBO volume in the loan market is more than full year 24 and 23 combined, double the 24 volume. So that's encouraging, although that is from a pretty low base. Flip side is that the bond market, or certainly the LBO side, has been very light. We've got a deal for Kelvion market this week. That is only the fourth name to issue high yield debt to support an LBO. Another sort of pocket, though, of interest has been the rise in dividend deals. The volume in the loan market has doubled for that, and it's shot up in high yield as well. And that's a reflection of the lack of LBO activity, with sponsors looking to extract value from portfolio companies so that they can return some cash to LPs.
Yeah, that's really interesting. I think that's kind of interesting from a market level perspective. But I guess what about beneath the surface? Are you seeing sort of certain sectors that are getting more interest, or any sort of kind of thematic themes, trade ideas or trades with beneath the sector level?
Yeah, look, coming into the year, when we always ask people, what are you underweight, overweight sector-wise, the underweights were definitely autos and chemicals. Now, that reminded me of the start of 24, when everybody really didn't like real estate. Last year, real estate went on to be the best performing sector in the high yield index by a considerable distance. It's not going to turn out that way this year. Although our autos have done pretty well. They're about 5.5% plus total returns. But the real laggard, the drag on the market, has been the chemicals sector. That is the worst performer. It's at negative 4%. But what we always have to remember is that whilst people can be bearish, bullish on sector, investors will always say it comes down to stock picking. So, for example, we were speaking to a manager who's overweight chemicals. That doesn't mean he's overweight every chemical's name. He just thinks that some names are fundamentally mispriced due to the bearishness on the sector. wouldn't want to buy into companies which have near-term maturities. But if you've got a 2031, 2032 maturity, then it might be that you're being mispriced and therefore it's attractive. I think the other one then to think about was obviously the LT situation, touched all corners of the market, both Europe and US. And that led to much greater scrutiny for what was, for a long time, maybe the darling sector of the high yield market. It is still the most dominant sector when it comes to primary issuance. So, there's a bit of a dichotomy there. And the other one I'd point to has been energy. It's also had a boost. It's been the best performing sector in the index so far this year. And notably, there's been a little rush of deals of companies that had typically funded in dollars, now funding in their euros instead, because that cross-currency swap is attractive. Or if you need euros and you're an American company, or you're a European company with European cash flows, it just makes more sense with where yields are in Europe to fund directly into euros.
Yeah, there's no doubt about that. That's been a huge kind of theme throughout 2025 year to date, with so-called reverse Yankees really tapping the euro market in a major way. I mean, if you look at especially on the sort of investment grade side of things, we've seen record reverse Yankee new issue supply so far this year, and that's coming from both companies with outstanding euro liabilities, but also first time issuers. And I think that's really sort of reflecting that major yield differential that we're seeing between the US dollar markets and Europe. And I think that probably is a theme that continues over the course of 2026 as we get into next year. So let's we talked about the market as a whole, kind of sector specific themes. What about in terms of ratings? I know it's been a fairly, I think, good year for double B activity, as you mentioned. We've seen even so the primary market reopen to some of the more levered single Bs. But what about triple Cs? Valuations there are trading at pretty extreme levels in terms of both spreads and yields for triple Cs. What do you sort of make of that sector or segment of the market?
I mean, it's a sector that we ask the buy side about a fair amount because it oscillates those spreads through the year, and they tend to be a reasonably decent barometer of risk appetite. This year, though, generally we've seen them widen out, and that's been despite pretty good primary market conditions and even secondary conditions, and that ultimately reflects that people are cognizant of wanting to stay safe, avoid the landmines. In fact, avoiding blowups is probably one of the most frequent thing that I am told by investors. So it's meant more have gone overweight. I think when you're thinking about triple Cs, you really also need to look across to the loan market because there have been a slew of downgrades into triple Cs, and that has impacted the triple C buckets of CLOs. But by and large, these have been manageable. It's not as if many OC tests have been breached. And when you speak to CLO managers, it's a lot more about what flavor of triple C they're comfortable with. And in the CLO market, it's been a very reset heavy year. And that means that the equity investors are scrutinizing portfolios quite closely for that triple C risk and asking managers to justify why they have this name or that name. Pretty difficult to completely avoid triple Cs in the loan market, considering the number of downgrades. So I think that's to be taken into account. And then just to flip back to bonds quickly, there is a difference between subordination risk from very good quality credit and pure credit quality triple C. We saw last week Picard do a triple C unsecured deal. They've been rare. The bond market has not wanted to fund unsecured paper below the double B level, particularly in the last few years. And the reason for that is when we take a look at the outstanding triple Cs, unsecured paper, just more than half of them are trading in stressed or distressed territory. So that sort of paints the picture there.
Yeah, no doubt. I mean, I think really what comes down to is, when you do have tight spreads, I think it's definitely tempting to sort of look at triple Cs when they're trading this wide. But, I would argue that, some of this fragmentation in terms of valuations definitely was reflecting that sort of high degree of uncertainty for some of the higher leverage issuers. We put a note out back in September, sort of looking at single name, so-called zombie companies, which is basically, issuers with very low sort of interest coverage ratios and some, more negative, fundamental catalyst. But I think that's really where, I think you got to really do your credit work when it comes to, investing in some of the more kind of very low cuspier names within the Triple C universe. But let's kind of dive in a little bit in terms of that sort of credit specific, themes going on. We've had in the last couple of months headlines around so-called cockroaches within the LevFin market. I think that's more so a U.S. story, but certainly it felt like the market was a bit weaker a few weeks ago when we did see news around Tricolor, First Brands. I guess, Luke, how is that sort of impacting Europe? Is it, or I guess, how are some of these more blowups impacting sentiment across Europe, particularly?
Well, it's certainly focusing people's attention, that's for sure. And, anecdotally as well, you mentioned your zombie report, which I'd add, we did a short synopsis of this at LFI, and it's one of our most widely looked at pieces that we put out this year. So anyone that hasn't taken a look at that, I strongly advise you do. But look, ultimately, it's made the market a little more skittish. It has reminded certain pockets of money that potentially it is better to sell first and worry about it later. It's accentuated that sort of gap risk in loan secondary market. And, that's a big deal for the loan market. It doesn't have upside above par. If you're going into primary transactions, 99 3/4, you're sat on a lot of downside risk. If you buy in secondary and you buy 94, 92, 94, yeah, you've got 8 points of potentially of upside, but you've got 50, 60 points of downside risk. And First Brands, it took from 2 weeks from failing to refi to essentially being in bankruptcy. So, things can go sour on you very quickly, and the market had become used to spreads tightening, things holding firm, nothing really rattling the markets that much. I think that these, whilst it didn't cause a sell-off, it certainly made people a lot more aware of what am I holding and am I comfortable with the potential price action on that risk.
Yeah, I think that's a great lesson just for the market overall. Things can really sort of trade sideways or go sideways when you have spreads that are so tight. It doesn't take a whole lot to really cause sort of an unwind in terms of valuations. And we've seen that a handful of times this year already when it came to the tariff announcements back in April, more recently with some of the the French political situation back in early October. Definitely, I think when spreads are this tight, we're trading basically at cyclical tights, both across high yield as well as investment grade. It doesn't take a lot of bad news to really sort of lead to sort of disorderly unwind. But Luke, do you think that investors should be worried, or are investors more worried, about more bad headlines to come when it comes to kind of single name blowups?
Well, I think they probably should be. But, the flip side to that is default rates remain reasonably low. In the cov-light world, it is difficult to trigger. Again, flip side to that is when something goes wrong and it is triggered, it's a real issue. As I said, the First Brands was rare, and the speed in which it went sour. And I think that what that has done is maybe potentially meant that in a world where the E in ESG had been the main focus, perhaps a bit more focus will be and should be on the G. And I know that our colleagues at Sustainable Fitch, they put out ratings across ESG, but also weightings and on the specific E, S, and G. And I was at a round table this morning with a group of investors, and it was clear that governance is something that everybody is thinking about a lot more closely.
All right, so we've talked about sort of the key themes from this year, key takeaways. Let's kind of get into some of our preliminary thoughts for 2026. And let's start just with the primary market. How are you thinking about, in terms of next year, in terms of just kind of overall high yield bond issuance, perhaps even sort of the split between bonds and loans as we get into next year?
Well, I mean, yeah, it's a little early to be able to give an accurate consensus, but what is clearly starting to emerge is that gross volumes may struggle to challenge this year's, but new money should hopefully be on the rise. I mean, when you're looking at the opportunistics, that double B trade is still going to take a bit of time it's always going to wait until the last minute before it can refinance. We've had such a large repricing wave across loans that without seeing liabilities come down in the CLO market, it's hard to envisage another leg down in pricing. Although that said, these occur because the market is so technically unbalanced. And by that, I mean, there's just so much money chasing not enough new money paper. So, the big question mark is around the pickup in M&A LBO activity. And when I think about that, to be honest with you, it feels pretty much like it did this time last year, that there are many good reasons to think that this is going to pick up. Private equity has sat on holding companies for longer than they would like. They need to return value to LPs in order to be able to fundraise further. And yet it didn't really materialize this year. I mean, I started the podcast by saying how, volumes were up and doubled from last year in the loan market, but that's really from a very low base. That said, normally, if you keep saying something for long enough, eventually it comes true.
That is a very good point, Luke. I think you can pound the table as long as you want, and eventually something will, shift in terms of your favor. What about like the maturity wall? We talked a lot about refi. Are there any sort of pressure points that you're paying attention to next year?
I mean, I think when you're thinking about names going sour, by and large, the big over-levered capital structures have already been outed. So I think the focus or the shift will be to those smaller cap stacks where maybe you've got a single bond or a single loan, and they were put in with maybe a little bit too much leverage at that time, and the companies haven't grown into that capital structure. I think that's where you're going to start to see a bit more pressure. And you're already starting to see that across the loan market. I mean, especially the loan market, because that is much more of a single B rated market. So it feels like you might see more risk in there. For high yield, yeah, look, we do expect it to be, refi heavy. And I think one of the things we're looking at, maybe I'm barking up the wrong tree, but it's around the maths. So we still think that it'll be the 2027 and early 2028 that people are going to need to address that are low coupon paper. And as I say, the double B's will wait. But interestingly, that 2023, 2024 set of issuance with largely 5-year non-call 2, that starts to come into its call period, out of its call periods. And new issue yields were higher back then than they are now. So in principle, you should be able to reduce your cost of capital, but you should be able to lock in a lower coupon. The interesting dynamic, though, is that with the market par plus 50% coupon, that first call could be prohibitively high. It'll be interesting to see if many people start to try and chip away at those early, or whether that call, those high first calls or even second calls, sort of mean that people have to sit on higher coupon debt than they want for a little longer than desired.
Yeah, those are really good points. I guess from sort of our perspective, I think the maturity wall is actually, for now, kind of the silver lining when it comes to kind of fundamentals, especially considering that the macro outlook still remains pretty clouded going into next year. Luke, as you mentioned, the lion's share of year-to-date issuance has really been earmarked for refi. Based on some of the numbers we've been looking at, maturities over the next couple of years, especially on the high yield bond side, do look pretty manageable. So, more than half of 2026 maturities have already been taken out since the beginning of 2025. So I think from sort of a fundamental perspective, that is one of the key, I guess, positives that I think should keep at least, default rates from really moving much higher next year, depending on sort of the economic backdrop, which I think again remains pretty uncertain for 2026. Luke, let's hear. I'd be remiss if we just didn't ask about a little bit about CLOs. What are you seeing in terms of CLO demand for next year?
Yes, of course. Love a conversation about CLOs. I won't lie. So we at LFI have what I believe is unique data on warehouse registrations, and that is probably the best indicator of future CLO issuance. So to set the scene a little bit for you, I'll give rough numbers, but in 2024, a little shy of 160 warehouses were registered, and there are about 34 remaining outstanding today. So you could see that what was registered in 2024, the vast majority of it was securitized in 2025. So how many have been registered so far this year? Just over 160. We've got about 135 that haven't been issued so far. So you should be thinking that CLO issuance will be broadly similar to what it's been this year. And if you look at CLO issuance, though, just not new issues, but of course resets and refis, it's a record year this year. We have seen a few new debut managers coming to market this year. We've got a pipeline of another few debut managers coming next year. So the number of managers issuing has definitely accelerated in recent years. What has fallen away a little bit is mostly down to the lack of collateral, is maybe you're not seeing, the 4 or 5 deals from the very largest CLO managers. But CLO demand will remain very healthy through next year. And the question mark will be, is there enough new money paper to feed that?
All right. So speaking of new money paper, you mentioned earlier a little bit about kind of M&A failing to pick up as anticipated. But what are you hearing for next year about sponsor activity?
I mean, banks are generally constructive. I mean, it depends on which bank you speak with and how busy that bank would normally be. Some of the big banks have been very bullish, and they've had the largest number of sell-side mandates looking at underwrites that they've had for many years. Others a little more skeptical. We've got some decent size. We've got some very big transactions that are sort of in the pipeline that probably won't emerge until Q1. So look, it feels as if it is healthier, but healthier is kind of an abstract notion. It's relative to what it's been like in the last few years. That valuation gap, which has been the real hindrance to a pickup in LBO activities, it certainly hasn't been the debt markets. The debt markets are there, they're there in size, and they're still relatively cheap. It's that's needed to be narrowed. And I think this year we've seen a pickup in hybrid capital. By that I mean sort of PICs and pref equity, which has helped narrow that valuation gaps and greased the wheels. Certainly one of the large law firms I was speaking with yesterday was of the view that they think there'll be a real pickup in that hybrid capital to try and help narrow that valuation gap. And as I say, grease the wheels. The other part that we're seeing a bit more of is public to privates. Corporates are divesting non-core assets to try and shore up balance sheets. But these are difficult, lengthy transactions. They take a lot of time. And the banks are certainly there for them, but it's not their preferred transaction because they have to sit on the underwrite for such a long period of time. But, last month we knew of more than a handful, maybe shy of 2 handfuls of potential P2Ps that have worked on. So we feel that the market is well placed for a pickup next year. I just wouldn't want to put my neck on the line and give you outright numbers, but more than this year.
Well, that should be music to high yield investors' ears. But what do you make of just current appetite for kind of re-leveraging transactions within that market?
Well, here I'm going to do what I dislike so many of my sources doing to me, and say that it really is credit dependent, name dependent. We have seen a fair number of re-leveraging transactions this year, and generally, if a credit has proven that it can delever, that it's cash generative, that there are barriers to entry, that it has a sound underlying business, then investors will accept it. And if truth be told, they'll do more than accept it. So such has been the demand for new money paper that these often bring new money opportunities, and therefore the buy side is probably more open to them than they would like to admit on principle. And look, we've seen some very large recap and dividend transactions this year. We've had, just to name a couple in the month or so, there's been Urbisa and Verisure. So there is undoubtedly a strong demand for the dividend deals. And as I said, the volume of dividend deals has, clearly sort of shot up this year.
All right. And then just to kind of sticking with the, the sort of releveraging activity, what size deal do you think the European leveraged finance market could digest? I mean, we're seeing numbers, I think, on the U.S. side that are quite large in terms of some of the LBOs. We'll get into that just in a second. But what's your kind of sense of dry powder that's sitting on the sidelines in Lev in the Europe market?
Well, look, I mean, when you're looking at how big a deal you can do, you've got some touch points this year. They've been cross-border, but Boots did 4 billion plus. Skechers did a similar amount. And they did that with ease. I mean, there was more that they could have done. When it comes to pure Europe, it's a little trickier to say. And that's in part because, as I said at the top of the podcast, high yield has been reluctant to fund the unsecured piece, the sub piece of the pie. So that means that loans and bonds are effectively offering financing for the same part of the capital structure. And that means you're getting very stretched senior, but you get very stretched senior capital structure. And then the third piece of the puzzle is the private credit side. That is willing to offer sizable second lien or unsecured bits of paper. But, as you asked me for some numbers, look, I think you could take out 1.5 billion of loans with relative ease. If the credit was good, you could probably do similar in high yield. I just don't envisage that you're going to get a cap stack that wants 3-4 billion of euros secured debt. And at those numbers, I don't think banks would ever limit themselves to just doing it in Europe. They would go cross-border to drive that price tension between the regions.
So are there any takeaways from the, Electronic Arts LBO that was announced, I think, last month, largest LBO ever as it pertains to the Euro market?
Yeah, I mean, look, it's big, and that excites people. Although, truthfully, it probably excites, my team, the journalists, and our peers a little bit more, and certainly the banks that can get the arranging fees. What I'd remind is that one large deal, whilst helpful, it isn't what the market really needs. It's not one big deal that solves issues, because CLO's only going to take 2-3 million clips of it. What you really want is deals count of reasonable size. That's what the market would most love. But that said, that a single bank initially underwrote that entire Electronic Arts deal, I'm sure he did some sub-underwrites, but was willing to take the whole thing on, shows you, A, that the banks really are there in size to underwrite. And that's because, the LBO M&A fee generation has probably not been quite as strong as they would have liked in recent years. So, and, remains to be seen how cleanly the syndicated market takes this transaction down. But you have to be enthused that the banks were willing to put, so much of their balance sheet to work for this transaction.
All right, so let's end with one more topic, which is private credit, which clearly continues to gain, more interest and more traction. And I guess there are a lot of opposing views. We've done a number of presentations and podcasts on the subject. But I guess first, Luke, are you seeing more interest from clients in the private credit space?
Without a shadow of doubt. I mean, you can't have so many in the market, referring to it as the golden age of private credit, and yet at the same time, it'd be a bit of a black box in terms of how much information you can get without it leading to a significant increase in people's interests. It is also a firm feature of the market now. It is the third pocket of capital that is available. And that can be good, bad. But Really, it's the lack of transparency that means people want to know more. What are in people's portfolios? How is pricing? What is the relative value play between private credit and BSL? What is the pipeline of potential private credit takeouts into the BSL market? So without doubt, the interest in that asset class has rocketed in the last few years.
I mean, I guess like in terms of just sort of the impact on your LF end markets, like is it a fundamental positive because it opens up the door for other alternative sources of financing, or is it sort of like a crowding out effect and taking share from the markets? How are you sort of thinking about the impact?
I mean, look, from my position as somebody that just looks at the market, it is undoubtedly a good thing. It's friend rather than foe. You want a fully functioning market, and having varied capital sources available to suit a multitude of needs is nothing other than good. If you think about when private credit really started to show its worth in the general leverage finance market, it was a few years ago, went through no fault of their own, really, if some banks were left with some underwrite positions because the Ukraine war, etc., happened. Now, they'd have been stuck with those for some time. Private credit came in, and not out the goodness of their hearts. There was obviously an economic benefit, but they helped de-risk some of those positions. And that, again, helped grease the wheels for the wider leveraged finance market. I think that if you are a sponsor or a company looking at financing, look, private credit is very good at offering multi-currency financings. It's good at funding CapEx add-ons. It offers delayed draws. It is a bit more nimble. Broadly syndicated market is currently cheaper. Therefore, it is, you've got so many different needs that can be sorted through different forms of capital. The flip side, I suppose, depends on what seat you're in. If you're an investor, you might like the fact that the private credit market is there to help refinance out some of the tricky situations that you're in. If you're a bank, you may not be so enthused that deals go to the private credit market. So it depends on perspective. But I think by and large, everyone would agree that it has been a net positive.
All right. So net positive overall. I guess from your perspective and from your conversations with clients, where do you think things could go wrong? What are you sort of hearing about key risks from clients?
Well, it's usually people from outside the private credit space that are inquiring about this, and maybe that shows that the competitive people are worried about the competition that private credit offers. But really, what it usually comes back to is the lack of mark to market in private credit, and so that allows potentially rocky investments to be hidden from view. And maybe that creates a picture that private credit is a little more stable than people think is reality. People want to unearth that. But when you speak to things to private credit participants, they would point out that they have been through a cycle. They would say that defaults are not materially higher than BSL, and if they had been, that would have emerged. I suppose, again, to play devil's advocate a little bit, there have been instances where private credit shops have found it difficult to fundraise. I'm not saying that's across the board. It certainly isn't. But large amounts of money have been raised lending, but there have been pockets that haven't. And the feeling is that is probably a consequence of some of those investments souring that maybe the wider market didn't know about, but certainly the LPs to those funds did.
All right, look, well, this has been a really helpful and kind of well-rounded discussion. I know we could probably go on for, another half day or so when it comes to some of the themes we're looking for next year. But this has been really good. I think it'll be helpful for me as well as we're thinking about our full year 2026 outlook. So really appreciate you joining and taking the time today.
Absolute pleasure. Thank you very much for having me on, Logan.
All right. Thanks, everyone, for listening. Have a great day.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.